Gold just hit 53rd all-time high this year, 53, and every single one of them landed on a week where inflation came in above target. And this is not coincidence, this is countdown. Because the surge everyone is calling temporary is accelerating, and gold is not breaking out. It is getting started. The inflation stayed above the Federal Reserve's 2% target for 47 consecutive months. In the same window, gold climbed from $2,600 to over $5,000, shattering all records. But if the gold is at all-time high, why do the numbers say the real move hasn't even started yet? Gold doesn't move on fear. It moves on arithmetic. When the money supply expands faster than the economy produces goods, each dollar loses a fraction of its claim on real things. Gold replaces to fill that gap. Therefore, the variable that matters most is not the gold chart, it is the money chart. In June 2025, M2, the Federal Reserve's broadcast measure of dollar in circulation, crossed $22 trillion for the first time. By February 2026, the year-over-year growth had accelerated to 4.9%. Demand deposit alone surged 8.9% to $5.68 trillion, the fastest expansion since 2022. To put that in physical terms, the United States created more new dollars in last 14 months than the entire GDP of Germany. But money creation alone doesn't ignite gold. It takes a second ingredient, one that Fed has been unable to neutralize for nearly 40 years. Because when new money enters the system, the inflation refuses to fall. Every new dollar is another breath into the balloon that nobody is letting the air out of. And the rubber is already stretching thin. So what is that second ingredient? It's the sticky inflation. The Consumer Price Index, the CPI index, for February 2026 rose 2.4% year over year. Well, that sounds moderate until you realize it hasn't touched Fed's 2% target once in 47 months. Not once. The Fed projected victory by late 2024. It is now spring 2026. And the finish line keeps moving. Because the deficit is a credit card bill being paid with another credit card bill, the federal government is borrowing $50 billion every single week. Interest payments alone will exceed $1 trillion this fiscal year. Money that enters the economy and pushes price higher before a single road gets paved or a single school gets built. And this is the loop. The government borrows to spend, spending generates inflation, inflation raises the cost of borrowing, which requires more borrowing. Every trip through that loop speeds up the treadmill, and the person running in the treadmill is out of breath. In the 1970s, the same loop ran for decades and gold went vertical. But today, the national debt is 101% of GDP, a ratio that did not exist during the last cycle. So if the 1970s gave gold a 2,300% runway, what does a bigger debt load give it now? Between 1973 and 1971, inflation averaged 8.8% a year. Gold returned 35% annually over the same period, climbing from $35 to $850. That was not speculation, it was repricing. Every dollar of purchasing power of the currency lost, the gold absorbed and reflected back in price. But here is what makes the current setup more charged than 1970s. Back then, central banks were seller of gold. Today, they are the largest buyer on the planet. In 2025, central banks added more than 1,200 tons to their reserves, the third consecutive years above the 1,000 tons. BRIC nations alone accumulated more than 600 tons worth $91 billion. Therefore, gold now has a structural bid underneath it that did not exist in any prior cycles. The 1970s breakout was retail-driven. This now has sovereign weight behind it. And yet, most investors are still sitting in the same position as before as the dynamics changed. Why? Because the same system that benefits from dollar dominance doesn't want you to watching gold. The US dollar share of global foreign exchange reserve fell to 56% in 2025, the lowest in 30 years. But the institutions that earn fees managing dollar-dominated assets have no incentive of broadcasting this decline. Every dollar that moves into gold is a dollar that leaves their balance sheet. Meanwhile, Federal Reserve keeps projecting rate cuts that never quite arrives. 2 to 3 cuts were expected in 2026, but the inflation above target makes every cut a gamble. Low rates could reignite the price growth and send gold parabolic. The Fed is pinned, cut and the gold surges, hold and the debt spiral tightens. And this is exactly why the breakout keeps accelerating without mainstream coverage. The moment Wall Street acknowledges that gold is outperforming their entire product shelf, the capital rotation becomes inevitable. But the rotation has already started in sovereign level. Global gold reserve just overtook US Treasury holding for the first time in 3 decades. $4 trillion in gold versus $3.9 trillion in treasuries. If the largest institutions on earth are already repositioning, what should you do? First, track M2, not CPI. The money supply leads inflation by 12 to 18 months. If M2 growth continues accelerating past 5%, next inflation wave is already baked in. And gold will price it before the headline catch up. The Federal Reserve publishes the data every Thursday. Second, watch the central bank buying report quarterly. The World Gold Council releases demand data every quarter. When sovereign purchases stay above the 1,000 tons per year, it confirms that the structural bid is intact and floor under the gold keeps rising. Third, measure your exposure to purchasing power, not dollar. If inflation runs at 3% for another 5 years, $100 today will buy what $86 buys in 2031. And every month you delay repositioning, the cost of entry rises. Not because gold gets more expensive, but because your dollar gets lighter. Hope you enjoyed this video. My name is Shan, and if you really liked it, then please press the like button. And if you really want what's coming up next, then please subscribe. See you in the next one.